Well, thank you, everybody, and thank you for bringing us all together today. I'm very grateful for this opportunity to help you all take full advantage of zero tax planning. Before I jump into the specifics of zero tax planning, let me give you the big picture. There are now more than $200 trillion of assets in the world, and almost $100 trillion of that wealth is here in America, about half of the global wealth. Of that 100 trillion, there's about 25 trillion sitting in retirement plans and over 60 trillion sitting in estates that will transfer to the next generation over the next 40 years. These numbers are very important because the government is closely looking at all these trillions of dollars of wealth and planning to tax the wealth at rates that will often exceed 50%. For example, if you have a large retirement plan and you don't use it all during your retirement, when you try to pass it to your kids or grandkids, there will be an income tax, which can be at a 50% rate, and there can be an estate tax at a 40% rate. And even though the income tax is deductible, ultimately only about 20 or 30 cents on the dollar will go to your kids and grandkids from your retirement plan. Similarly, if you have a business, when you try to sell it to the next generation, it'll be taxed, or if you try to transfer it with your will or trust, it'll be taxed in almost every case. So as a result, the government plans to keep about 40% of the business wealth through taxes. And it's exasperating that you work so hard following Christian principles to build all this wealth, and then it's taxed away through secular government coffers that will use it for purposes that are often contrary to your Christian purposes. So the essence of what we do with zero tax planning is we help zero out those unnecessary secular taxes so that all of your wealth can be used for God's glory. We know that God owns the cattle on 1,000 hills. We know that the earth and the world are God's and everything in it. And we know that all that wealth is given to us to steward. So to the extent you have part of that $200 trillion of wealth, to the extent you've got a retirement plan or a business or any other assets, you have to ask, do you want part of that wealth to go to taxes, involuntary philanthropy, secular causes, or do you want all of your wealth to be used for God's glory? So today we're going to show you how all of your wealth, all of your assets, and all of your income can be used for God's glory. Now, if zero tax planning allows you to zero out all estate and gift taxes, if it allows you to zero out all unnecessary income and capital gains taxes, why is it that not everybody is doing advanced zero tax planning? Well, in one of my books on the best zero tax planning tools, I give you 6 reasons why they're not doing it. But the simple reason is that people think it just sounds too complicated or too good to be true. So what I'm going to do today is greatly simplify the zero tax planning process by explaining 6 different aspects of it and then showing how it all ties together. And just so you can remember everything we're discussing, you're welcome to take one of those cubes that shows the 6 different aspects of zero tax planning. It shows there's an income tax side and a state tax side, a business side, a charitable side, an investment side, an insurance side. And as long as you understand how these 6 sides integrate, you can have a zero tax plan. And those disappeared faster than I thought, so feel free to give me a business card. We will send you one of these if you didn't get it. In fact, those of you that didn't get them off the table, we'll send you 2. Just give me your business card. We'll make sure you're taken care of. But this simple little cube really does explain the process elegantly, as you'll see on these slides. And ultimately, we will show you how to solve the planning puzzle. Now, some of you might know that if you try to solve the cube, it looks so simple, but there are actually 43 quintillion different ways to solve the puzzle. And if you don't know the algorithm, if you don't know the math, it can take you days or years. But if you know the algorithm, you can solve this in a minute or 2. And it's the same with zero tax planning. You can spend the rest of your life going around talking to all the CPAs, lawyers, insurance agents, investment advisors, accountants, development officers, and others that will tell you how to zero out taxes. But the challenge is getting everybody in agreement. And today what I'm going to show you is a process to get all of your advisors to agree so that you really know which of the hundreds of planning tools work best, how to integrate them, and then how to summarize them in your financials and your legal documents so you can have a simple zero tax plan. Now, with all that being said, it is important to continue to look at the huge opportunity available for those of you in this room. When I started doing zero tax planning back in 1978, we used to try to solve every problem with 3 tools: investments in a mutual fund, insurance, and a basic trust. Now there aren't just 3 tools, there are over 1,000 different tools. And now there aren't just a handful of people making a lot of money. Millionaires, in fact, decimillionaires and centimillionaires are all around us. We now have 2,000 billionaires, including dozens right here in the state of California. We now have over 70,000 people that are earning over $1 million a year here in California alone. Over 700,000 nationally. They're earning over $1 million a year. And what's happening is those of you that are earning more than $1 million a year, or the many, many people that are earning over $400,000 a year, are going to your CPAs and you're saying, help me lower my taxes. And what's your CPA say? Well, they'll say, congratulations, you're making a lot of money, you should feel good about having a big tax bill. And they'll say, yeah, we can help you lower it by $40,000 or $50,000 a year with a pension deduction, and we can help you make some outright charitable gifts, and we can help you reduce the damage. But CPAs are not trained to help zero out the taxes. So almost all my business these days comes from CPAs who risk losing their clients. They call me up and say, I don't know what to do for this guy. He's making over $1 million a year, or he's making over $400,000 a year. Please show him some advanced planning tools. Or more often, it's increasingly women. Please show her some advanced planning tools to zero out the estate tax and zero out the unnecessary income taxes. So I'll show you all today what we're doing for people that are earning over $1 million, but everything I'm discussing should in most cases apply to anybody earning over $400,000. And in fact, if you're earning less, we can certainly help you there. We're not going to be elitist about this. We help the widows and orphans. But the strategies today are mostly going to be focused on the really high income or high asset estates. One of the first questions I get as I make these bold promises that we can zero out your taxes is, how legal is all this? And let's turn to what the judges say. Judge Learned Hand said, in America, there are 2 tax systems, one for the informed and one for the uninformed. Both are legal. If you're informed, you can see that there are legitimate legal techniques routinely upheld by the court and affirmed by statutes consistent with public policy to zero out your taxes. Now, some of the statutes are questioned. Sometimes these cases will go to tax court, and then you'll have a judge opine on the legality or the application of a strategy. One famous judge is Supreme Court Justice Louis Brandeis, who was talking about tax avoidance versus tax evasion. And he used the example of how he avoids taxes by taking a free bridge instead of a toll bridge. And just briefly, it says, he went over the toll bridge out in Washington, D.C., and through the barrier without paying a toll, and he would be committing tax evasion. However, if he drives the extra mile and drives outside the city of Washington, he's using a legitimate, logical, and suitable method of tax avoidance. And he's performing a useful social service of reducing traffic by doing so. For his tax evasion, avoiding the toll, he should be punished. For his tax avoidance, he should be commended. The tragedy of life today is that so few people know that the free bridge even exists. The tragedy is so few people understand that the law actually allows you to zero out taxes by giving to charity, by giving to family, or by performing other socially useful services. One way to understand how the tax code works is with this graphic. As I indicated in my presentation at 11:30 this morning, most of you are spending 3 to 6 months working for the government. When you add up what you're paying in income taxes, capital gains taxes, IRD taxes on your retirement, estate taxes, gift taxes, it's extremely common to lose over half of your hard-earned wealth to the government. In this example, I'm saying 65% is controlled by you, 35% goes to the government. We've got an alternative where you control 90% and the government gets only 10%. The difference is that by integrating the tools, we're able to dramatically reduce this portion that goes to taxes from maybe 35% down to 10%. And all we're doing is we're redirecting tax money to favorite charities, and in the process, we're usually getting more money for retirement or more money for family. In a practical sense, I'm talking about a charitable remainder trust, a pooled income fund, statutory tools that have been around since 1969. And if they're designed properly, they really can help probably everybody in the room increase the amount of wealth you control by having more in your personal trust, your retirement trust, and more in a charitable trust so that much less goes to taxes. That's the essence of zero tax planning. Now, it does get a little bit complicated because it will take 6 types of professionals to implement some of these plans. And what I've learned during my 40 years of doing this, the simplest way to get the plans done is with one-stop planning. So in my firm, we actually have a law firm, we've got a business succession consulting firm, we've got an income tax firm, we've got an investment firm, an insurance firm, and a charitable planning firm, a family office foundation. And we can do one-stop planning, but we're team players. If you've got existing advisors, we always will work with existing advisors because collaboration is important, especially when we're doing Christian planning. You want everybody to be really biblically grounded, guided by the Spirit, focused on what's best for the client. So what we need to do is clarify whether your existing advisors will do everything or whether your existing advisors need some help. But the bottom line is you need teamwork covering these 6 sides of the cube. The first side, the side that really drives most people, is the income tax planning side. So folks will come to us, usually at year end when they're in a difficult situation, saying, help, my CPA just told me that my taxes are going to be at a 53% rate for ordinary income and a 36% rate for capital gains. Now these rates were a little bit higher until the end of last year. They dropped a tiny bit on the federal level with the new tax bill, but the state taxes in California are just as high. Those of you earning over $322,000 are going to be in the 50% bracket because you've got a 30% federal rate, you've got a California rate that's going to be close to 12.43, and then very often you've got taxes on your passive investments. So 50 to 53% rates are really common. If you're selling a business, it's often a surprise to see how high the capital gains rates are, especially in California or New York or other high tax states. Many of you watched how you bought your business years ago, or your father or grandfather or grandmother sold a business and had very little taxes. But now, when you look at the business sale economics, you'll see that you as the seller are going to get hit with a 35% or higher capital gains tax, and then the buyer has to pay with after-tax dollars. So literally the cost of buying and selling a business is more than double when you consider the taxes on both sides. But using these types of techniques, you can zero out the taxes to the seller, you can sell your business tax-free, and you can reduce the taxes to the buyer. You can show the buyer how, in many cases, they can get tax deductions for buying your business. So the economics are much more favorable. So the big challenge you're going to discover is with CPAs, they're usually going to be historical. You know, the joke is that CPAs tell you where to go by looking in the rearview mirror. And I would say that to my CPA friends all the day long because the problem is CPAs really do just look at current and past financials. They're not really equipped or in many cases motivated to look at the future. So the CPAs will call us up and ask us to do future projections to lower the taxes. And we will routinely show how to cut those taxes in half. Now the reality is, if you're making $500,000 a year and you're living on the $500,000 a year, it's going to be hard for us to reduce the taxes very much. But that's not the reality for most people. Having done this for 40 years with thousands and thousands of high net worth people, I can tell you most of the high income, high net worth people are like the millionaire next door. If you've ever seen that book on how the person next door who drives a Toyota is often the one that has the most wealth. Or what's it say in Proverbs? There's a man who appears to be rich who has nothing and a man who appears to be poor who has much. That's the reality. The millionaires are very often the normal people who have accumulated a lot of wealth. And they do that by living on a modest budget. So I've worked with billionaires who literally are living on small amounts. I guess a better example is I work with a lot of people that are worth tens of millions of dollars that routinely live on $20,000 a month, $240,000 a year. Or even our really high income, high net worth people very often live on $25,000 a month, $300,000 a year. So if you're living on $300,000 a year and you're making $500,000, you've got $200,000 of extra income every year where you're paying taxes at a 50% rate or higher. And that's not necessary. You can zero out all the taxes on that extra income you're not using for your lifestyle. You can also, as I said, zero out taxes on capital gains and estate taxes. I just need to caution you, if you're really living on everything you earn, it's going to be more difficult to zero out taxes. Here's an example, and I'm happy to email you these slides, larger versions of these slides, if you'd like to see all the specifics. But what we typically do with the client is we project out their income through life expectancy. And quite often we'll go out through the grandkids' lives. And we'll show them how much they need. And I realize this font is really small, but like I said, they might need $250,000 a year growing at the inflation rate. And we show how that's going to be used for their lifestyle, for their education, for charity, etc. But then they've got all this extra money, maybe $200,000 a year, taxed at a 50% rate. That red ink there can all go away if you use zero tax planning. Here's the benefit. If you have $500,000 a year of extra income, or let's say you've got $100,000 a year of extra taxable income for 5 years, $500,000 of extra taxable income. If you can invest it tax-free for 30 years, $500,000 turns into $5 million, 10 times growth. That's why compound growth is the 8th wonder of the world. But as you're going to see throughout this slideshow, very few people take advantage of such amazing tax-free growth. Most people, if they have $500,000, are going to lose half of it at their top marginal rate, leaving $250,000. They're going to invest it in accounts that are taxable, so they lose more money, and then they're going to typically put it in vehicles where it comes out that'll be subject to transfer taxes, like gift and estate taxes, so they lose more money. So with the typical person, we see $500,000 growing to maybe $662,000. But with zero tax planning, it grows to $5 million. And the question I ask you now, which I'm going to repeat with several other slides throughout this slideshow, is would you rather have that level of compound growth or that level? Well, the answer is obvious. So here's how you take advantage of zero tax planning. We have two different pyramids. One is to get rid of taxes on capital gains. The other is to get rid of taxes on unnecessary ordinary income. And again, I'm happy to send these to you so you can read the small fonts. But let me explain how it works with the income tax pyramid first. As I said, we have over 4.5 million people out there, including people in this room, who are earning more than $400,000 a year. Most of you are getting a lot of W-2 income. So you have heavy FICA, FUTA, SUTA taxes, federal unemployment taxes, state unemployment taxes, Social Security taxes. And then once you get your money out, it's taxed at the highest marginal rates because it's ordinary income, W-2 income. Most of America's high-income people are here at the bottom of the pyramid. So they come to us and they say they went to their CPA and all their CPA could recommend was a 401k, a defined benefit plan. And with most of them, for a lot of top-heavy reasons and other regulations, they can only put token amounts into their qualified plan. So they come to us and we say, well, that's too bad, but we'll help you get much more into a tax-efficient vehicle using a non-qualified plan, where the owner of the company, the chief executive, can put far more into a non-qualified plan than you could put into a tax-qualified pension fund or 401k. And that helps, but there are still limitations in that when the money comes out, it's going to be subject to high ordinary income rates. So then we climb to level 4, where we start using deductions from charitable tools or non-charitable tools. So we do dozens, hundreds of charitable remainder trusts. They get you deductions. We also do gift annuities and deferred gift annuities. But most of our clients have opportunities to use some non-charitable tools like R&D tax deductions, domestic production credits, intellectual property deductions, and then under the new tax code, Section 199A deductions. And the list goes on and on. This is just a sampling. But it amazes us that when we look at the tax returns for the business and the individual, we usually find a myriad of non-charitable ways to generate additional tax deductions with specialized plans. Not only do you get the deductions on the front end, but then when the money comes out, you can usually get it out as tax-deferred income or sometimes tax-free income, or in many cases, capital gains income. So you see what's happening here. The higher you climb, the fewer and fewer the taxes on the front end, meaning the bigger the deductions this year, and the higher you climb, the more tax efficient the income is when it comes out. So obviously, we like the trend. If we're doing well at 4, let's go to level 5. Here we get into much more sophisticated charitable tools, like a intervivos grantor lead trust, otherwise known as a super CLAT. A CLAT has been around since 1969. It's a charitable lead annuity trust, CLAT. And it is a brilliant tool for zeroing out estate taxes, especially for old people. So when I run into situations where we've got somebody in their 80s or 90s and they haven't done any estate planning, we use the CLAT to have everything that would have gone to taxes go to charity. And then the heirs, the family members, get the entire inheritance tax-free by simply redirecting what would have gone to taxes to charity. Plus, they get to direct everything that was in the charity. So the CLAT works really well for zeroing out estate taxes. But if you do it now, you can zero out income taxes as well. So you put assets into a charitable lead annuity trust. You know that they'll be outside of your taxable estate with no 40% estate tax, but you also get a large current income tax deductions to offset a lot of your income taxes this year. Because it gets rid of both estate and income taxes, it is a super CLAT. And that's why we use this name for the Intervivals Grantor Lead Trust. We also use a restricted property trust to compensate your key executives. And it gets you large income tax deductions now using some well-established code sections. And then there are some more advanced charitable tools like the new pooled income fund. We can design a pooled income fund to get you a current deduction of 50 to 80% of the wealth you put in. And when the money comes back, you can typically get from 1 to 2 or 3 times your wealth returned to you across time. It's basically a nice way to get a tax deduction now, grow money tax-free, and then ultimately get it out if you need it during your retirement or get it out for your kids or your grandkids. But the best place to be on the pyramid is the very top, and we have done many of these advanced tools you see up here. I'll just give you a little summary, and then we can get into more details later, depending on interest levels. But the charitable ESOP is a way that you can sell your business tax-free. Let's say that you can't find a ready third-party buyer. You instead sell it to all of your employees. If you've got at least 50 employees, you've probably got a ready market to buy your business. Lenders will lend the money so your employees can afford to buy it from you. We can set it up so that there will be some deductions when they make the purchase, and then you can get all the money out tax-free. That's greatly oversimplifying it, but a charitable ESOP, a CHESOP, is a very nice technique to help you sell your businesses tax-free. Capital split dollar works especially well under the new tax code. There's this new section 199A that says you can have a 20% tax on your income if you can keep your income down around $300,000 or less. But let's say you have $1 million income. You need to get $700,000 of deductions to keep your income down to $300,000 to apply the 20% rate. One way to get $700,000 of deductions is with capital split dollar. You fund a retirement program for your key executives, and all the costs are tax deductible. I can get into the details later, but the bottom line is not only you get deductions now, the money grows tax-free, and then it comes out to your key executives during retirement as part of a golden handcuffs program. So not only do you get the tax benefits, you can keep your executives loyal because they vest across time. And that's one of the public policy reasons why the government allows this, because they want to make sure that compensation policies help maintain continuity of business interests. We do a number of captive insurance companies. If you do them right, you can get the money out very tax efficiently when you sell your business. A captive insurance company is basically your own personal insurance company that does what big traditional property casualty companies do. If you don't want to keep spending premiums to one of the big companies, you just set up your own captive. It costs about $50,000 to do that, sometimes a bit more. And then you get large deductions for putting up to $2.2 million a year, tax deductible, into an insurance company. And then if you manage it right, it can grow tax-free. And ultimately, when you no longer need the insurance, when you don't have any claims, you've got leftover money left in the policy or inside the captive insurance company, you can sell it tax efficiently. And the list goes on and on. But my point is, there are hundreds of tools out there, and the best way to know which ones are best is by simply understanding the tax benefits going in and tax benefits coming out. The same process applies with capital gains planning. If you are selling a home, if you're selling your business, if you're selling some low basis stock and you want to sell it tax-free, there are a couple dozen techniques to sell assets tax-free. And they're statutory techniques for the most part, where the government says it's fine. For example, Code Section 453 is the installment note provision. It's been around for decades. It was revised in the late 90s and again in the early 2000s that says as long as you sell a business or sell an asset, you pay no current tax if you sell it on a note. And if you sell it on a note that goes for 30 years or 40 years, there's no tax until that note matures, which might be after you pass away. And there are a lot of ways that you can monetize that note during your lifetime. That's perfectly legitimate. It's a code provision that's been around for a long time to help people sell assets tax-free. And the different tools on here are likewise grounded in the code. So what happens though, more often than not, somebody calls me up after they just agreed to sell their business or sell their home. And they'll say, help, I just learned that I'm going to pay a 35% capital gains tax. What can we do? After you've already entered into a contract, it's very difficult for us to use most of these tools. Now, we do have a couple techniques we can use the day before you close, but they tend to be a bit more expensive, a bit more complicated. Generally speaking, if you think you're going to be selling an asset, contact a tax attorney before you enter into a letter of intent or a signed term sheet, because that'll give you the most flexibility. You definitely need that flexibility if you're going to use the second level solution of the gift annuities and deferred gift annuities, where the charity has to be able to help negotiate the sale. But you can sell it tax-free and then get some lifetime income from an annuity. Charitable remainder trusts are even more flexible. Some of you use 1031 exchanges. Those work if you can find a good replacement property and if it's an investment property. But if you can't find a good replacement property, we can sometimes use short-term 1031s and then combine it with these other tools. Level 4, we have both charitable and non-charitable tools. What I'm mostly discussing here is where you sell an asset for a long-term note and then you monetize the note. I'll get more into that later. Fifth, you can still use the charitable ESOP to avoid taxes, the pooled income fund, and then at the top you can use some of the tools we talked about already. But the bottom line is there's no reason to pay capital gains taxes as long as you understand all the flexible solutions. Now, as I get into the income tax planning solutions, you'll see very often I'm discussing charity. So let me talk about the charity side of the cube and drill down in a little bit more detail on charity. Essentially what you can do is take a deduction up to 50 or 60% of your income on Schedule A. It's a simple way to lower your taxes by 60% with a huge charitable deduction. Now, since I started doing this decades ago, we were limited to a 50% deduction. The new tax code says you can actually go up to a 60% deduction by giving to charity. So if you're making $500,000 a year, you can get a $300,000 deduction this year. Lower your taxes by 60%. But it's not quite that simple. You only get the 60% if you donate cash. If you donate assets, in most cases you're still going to be limited to 50% or 30%. But the bottom line is, even if you're donating nothing but low basis assets, you can deduct up to 30% of your income. I have the 2017 Schedule A, the 2018 is not out here yet, but right on Schedule A you can see how you can take that big charitable deduction. Now, one of our common techniques for people getting a charitable deduction is using a charitable remainder trust. So if you're selling your business or your investment property, you can sell it all tax-free. You don't pay any taxes until you take income out. When the income comes out, it will normally be at capital gains rates. So the question for clients is, how much income do you want to have come out? And most clients don't really know. You know you need some income right now, but you probably already have some wages or some other investment income. So most of our clients, when they come to us, are very focused on just getting a big tax savings. So we'll get them a deduction this year and the next few years. But we'll also get them some income from some sort of charitable remainder trust that might produce very high initial income and then kind of peter out with time. And then as that's happening, we'll have another charitable remainder trust that might be designed to produce more steady income for the rest of their life. And then we might have a third one that has a toggle switch, where if they don't need the income, they don't take it. And they just let it accumulate for their favorite charities. But if they do need it, they turn on the toggle, and then they get additional income through life expectancy. So you see, the income is very steady across time. It grows at the inflation rate. But even though what shows up in the mailbox, the income that shows up every month is very stable, the character of the income is varied because you have 3 different types of CRTs. So what we'll do is we'll figure out how much of a deduction do you want right now. And if you don't really need all the income right now, you can get a bigger deduction, so you have more income later. And we'll figure out how much income you need, and then we'll just combine various charitable remainder trusts, so the bottom line is custom designed for you. And that's a very conservative statutory assortment of charitable remainder trusts. When I say statutory, it means it's in the code. Go to Section 664 of the IRS code, passed in 1969, and you can read all the technical details about what I just said. Similarly, the superclat is fully statutory. And it's simply a way where if you sell an asset outright or you have ordinary income, after taxes you might have only this level of income. But if you use a superclat, you have far more income across time, and you control more wealth, because what would have gone to taxes will now be in a charitable trust that you can disperse to your favorite causes. Here's the Charitable Esop. This is one of the few tools where you're better off 7 or 8 ways. By comparing what happens if you do nothing to doing the proposed plan, you see that there's much less corporate tax, much less personal tax, much more for your kids, much less estate tax, much more for your charity, much more retirement income for you, and much more assurance that your business will pass to your successor managers or your kids according to your wishes. So it's clearly a win-win, 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 win-win outcome. You're better off 8 ways with a charitable ESOP. Now I could spend a whole day explaining how ESOPs work, but the bottom line is if you're trying to sell your business, you want to sell it tax efficiently, you're not sure you got a good, reliable third-party buyer, then a charitable ESOP is a simple tool. It's not difficult to do a little illustration to show you how you're much better off. That's the charity side. The third side is the investment side. And here in California, the numbers are extremely compelling. And to make this point, what I show my staff to do is go through our clients' income tax returns. Look at your 1040. You all can do this yourself. Look at schedules B, D, and E, and look at all the taxes you're paying on your investment income. You think you're getting a good deal by investing in those mortgage funds at 10%? Well, after taxes, you're getting 5%. You think you're getting a good deal by investing in those hedge funds? Well, after taxes, it's about half of what you think you're getting. You think you're getting a good deal with all those dividend stocks? A lot of times those dividends aren't qualified dividends, so you're losing much of that to taxes. And you think you're doing a good deal by all your day trading? In fact, I've got this one guy who called me up. He and his wife were making $5 million a year doing day trading, and they were just feeling so wealthy until they learned that all of that is short-term capital gains, taxed at ordinary income. They're losing half of it to taxes. And so what we show folks is you don't need to pay all the tax on interest or on dividends on Schedule B. You don't need to pay all the taxes on short-term or even long-term capital gains on Schedule D. And all those alternative investments that sound so good, where you're investing in oil and gas or solar panels or whatnot, that show up on Schedule E, once you really crunch the numbers, you realize that the taxes on the distributions from the partnerships or S-corps or from the trusts are much higher than you realized. So here's the consequence. If you had invested $1 back in 1926 and avoided all those extra taxes on Schedules B, D, and E, that $1 today, actually at the end of last year, would be worth over $7,300. $1 grows to $7,300 over the course of 91 years. But that's not what happened. If you just apply the regular tax rates on regular portfolio turnover and regular dividends across the last 91 years, that $1 grows to $873. So it's about 10 times more wealth, 9 times more wealth, if you just avoid the taxes through zero tax planning. And this is relevant because we now have more wealth than ever before in history. We know that many of you will be going into halftime, where you've been successful, but unlike your granddad and great-granddad who died at age 60 or 70, you're likely going to live until 80 or 90. You have an opportunity to do what Bob Buford says, go from success to significance. Take your wealth you've accumulated during the first part of your life and then invest it in trusts so you can have significant impact through your family and your charities through the rest of your life and through the next generation. You move from success to significance. Many of you, as you set up trusts for your family and your favorite charities, will be investing for the next 91 years. I mean, just look at the age of your grandkids. They're going to be around 91 years from now in many cases. So what happened the last 91 years is a really good indicator of what can happen the next 91 years if you invest tax efficiently. Now the challenge is you talk to a typical investment manager about wanting to avoid these taxes, and they'll say, sorry, but my E&O carrier won't let me give tax advice. So then you go to a typical tax lawyer and say, how do I take advantage of this? And they'll say, sorry, we don't do investments. If we were any good at math, we would have gone to engineering school instead of law school. So for that reason, it's hard to find tax lawyers that can really get into the investment side, and it's hard to find investment people that get into the tax law side. But if you can find people that can help you in both areas, then you can get that type of delta where you have far more wealth. One way that you can accumulate a lot of wealth tax efficiently is inside of insurance policies. Warren Buffett accumulated his billions largely by buying insurance companies and taking advantage of the tax laws that let you grow wealth inside insurance. You can do something similar. Now, there are traditional insurance policies, commercial policies from all the big carriers like New York Life, Minnesota Life, Pac Life, that are good, but they tend to have higher fees and they tend to have a big focus on death benefit. What's being used now are new types of insurance policies that are very different from what you've seen historically. In fact, when I present the new private placement life insurance policies, I say this is not your father's insurance. The insurance your dad bought had a huge death benefit for when he or your mom died, and it had almost no cash value. This is the opposite. It has the maximum possible cash value, the lowest possible death benefit. So it's more like an investment vehicle where you see a lot of cash growing. Moreover, your father's insurance had really high costs. These new policies have razor-thin costs, as little as 40 basis points a year for investment fees and as little as 1% for all the mortality costs. So the cash value grows a lot faster with lower costs. Moreover, as I indicated, your father's insurance was all about death planning. This is all about lifetime planning, where you build up a lot of wealth that you can use during your lifetime. Here's how it works. And you'll notice these numbers are similar to what I showed you a little bit ago on that investment chart. If you put sales proceeds from selling your company into a private placement life insurance policy, you could have $2.6 million, and it could grow tax-free to be worth $94 million over the course of 40 years. That's just the wonder of tax-free compounding. It could grow, from $2 million to $94 million across time if you put it in traditional investments. But because of the wonder of tax-free compounding, if you instead put it inside of an insurance policy with tax-free growth, the $2.6 million can grow to $312 million. So you see, instead of just having $94 million, you can have about 3 or 4 times more wealth by growing it tax-free inside of a policy. Now, you do have to carry some death benefit, and as long as you carry death benefit, it qualifies as insurance, so everything grows tax-free. If you're using these private placement policies, the cost of the death benefit is very low. So the economics are really good, and that's how you accumulate this much wealth. So basically, if you graph what I just said, traditional investment, it might grow to $94,000, but if you have the tax-free growth inside of an insurance policy, it grows to $312,000, and then you tack on a little bit of death benefit that'll be realized tax-free when you pass away. The key here is that all that money accumulates inside the policy in a way that you can access it, often with 0% loans. So when you need it, you don't take a taxable distribution, because that would be at ordinary income rates. You simply do a loan, and since you're borrowing your own money, you can do it at 0% interest, or at least very low interest. And as long as it's a loan, it's tax-free. Now, nobody wants a loan outstanding, including the insurance company that's lending you all that money every month or every year to live on. But you don't have to worry about that loan because you carry this death benefit that pays it back at your death or at your kid's death. So all I'm saying is if you've got a big chunk of money you want to grow and you want to use that money for lifetime income, if you think you're going to be in a high tax bracket during retirement, as most of you are, then consider growing it tax-free inside an insurance policy, taking it out tax-free with these zero-interest loans using a private placement life insurance policy. So that's PPLI, private placement life insurance. It's very common with the high net worth, high income people. It's typically not done through traditional insurance agents. It's done usually through CPAs and lawyers. But simply crunch the numbers and you'll see how without it, you have typically much less after taxes. Okay, the fifth side of the cube is the business planning side. And here again, we could do a day-long lecture on this topic alone. There are huge non-financial, non-tax aspects to exit planning, business succession planning. And fundamentally, it's really a spiritual issue of how does God want you to use your time and resources. And many of you have gotten to the point where you've built successful businesses, you've earned the right to move from success to significance, you've got some successor managers in place, and you want a way to sell the business tax-free. It's often a real challenge getting the buyers and the sellers to all agree. In fact, I'd say 95% of the time when somebody comes to me to sell a business, they don't even really know who the buyer is going to be, let alone what the terms are going to be. So we spend a lot of time trying to get the business ready for sale, trying to get the buyer to agree to the terms, and it ends up to being a big consulting engagement, getting everybody to come to agreement. But once there's agreement, there's usually shock, because as you look at the term sheet, you see that the taxes will literally be 35% on the capital gains. And if you've had accelerated depreciation, or if you're using any kind of management consulting contracts as part of the purchase terms, there's ordinary income at 50% rates. So then people will ask me, what can we do to sell the business tax-free? I could give you a couple dozen techniques, but two that we've used very successfully are right here: the enhanced installment sale and the installment sales trust. And these are some slides I used at a national conference where I spoke a few months ago. They're somewhat technical, but because it's a powerful tool, I'll review this for those of you that are selling businesses or selling assets. And one benefit of a non-charitable tool like this is, even if you've already signed a term sheet, if you've already got a signed letter of intent, you can still use this. You can literally put this in place the day before the transaction closes. So let's say Thomas Smith has a business worth $5 million, and they want to get all that money out tax-free. If they sell the $5 million business to the buyer will pay $5 million of cash. But as we said, they're going to lose a third of that to taxes. So what you do instead is you have Thomas sell the business to an intermediary. It's a third party who buys it for an installment note. And as we said earlier on, with the Section 453 installment note, there's no tax due. So the buyer has the building or business, and because they just bought it for a note, they've got to step up in basis. So they can turn around and sell it to a final buyer with no additional tax. Even if they had zero basis here, once you sell it for the installment note, there's a $5 million basis. They sell it to the buyer for $5 million, so there's no tax due. So it sounds really too good to be true. So here's what's going on. This intermediary has this installment note where they've agreed to buy the asset for the note, and the intermediary agrees to service that installment note so that the seller, that'd be you, can get installment payments at, say, 6%. So if you're selling a $5 million business at a 6% installment note, you're going to get $300,000 a year on the installment note. But instead of directly paying the money to you, what they do is they go out and take that $5 million note, and they find a lender who's willing to lend $5 million, minus some transaction costs, at 6%. And they agree that the 6% they were going to pay to you, they instead pay to the lender to service the note. And the lender agrees that as long as that note's being serviced, they'll just give you the $5 million tax-free. It's a tax-free loan. All loans are tax-free. So what would have been a taxable sale becomes a tax-free event. Now, again, it sounds too good to be true, and when you just look at the bottom line, it will sometimes raise audit concerns. And if that's a concern, if you just want no risk of an audit, then you shouldn't use a more aggressive strategy like this. But so far, we've had top tax lawyers and top accountants approve this transaction as a very legitimate statutory way to sell a business tax-free.
What happens if the intermediary goes bankrupt in those 30 years? You lose it.
No. The agreements, and this is why you need a law firm involved with this, the agreements are written in such a way that if the intermediary goes bankrupt or runs into other problems, it's a problem of the intermediary and the lender. There's essentially a hold harmless where the buyer gets your money right up front. This all closes literally within a few seconds as part of the escrow arrangement, and the money comes back to you tax-free. You've got your money, and the agreement says even if it all goes haywire, you don't have to give your money back. So those legal agreements give the seller a lot of confidence. But like I say, this is a complex strategy. Even though it's within the statute, it can be easily misunderstood. And if you just don't have the stomach for something that could be misunderstood or questioned, go with a plain vanilla charitable tool or some traditional tool to sell tax-free. But I can tell you we've got a lot of sophisticated people that have used this technique successfully. Yes? Well, you could sell to your kids on an installment note without even bothering with this. Sell it to your kids tax-free. You know, you've always got the risk when you sell on an installment note. What if your kids forget to pay you? You know, what if they default? Your only recourse is to go take back whatever you sold to your kids. And if you're 85 years old relying on that income, you're not going to want to go tell your kids, sorry, I'm defaulting, I'm foreclosing. So this is for people that want the benefits of the installment sale, but don't want the sleepless nights wondering whether their kids or the buyer will make the payments. Now this uses a third-party intermediary. There's another version you can do with yourself, where we would create a non-grantor trust for you, and you would sell the asset to the non-grantor trust for a note, and then the non-grantor trust would essentially be the intermediary and sell it to a third party, and all the tax, all the gains would be trapped inside the trust. As long as you invest it tax efficiently inside the trust, the money grows tax-free, and then you can lend it out tax-free or distribute it tax efficiently. Here again, there's some risk. This works. We've done it a number of times. There's actually a rule in California that questions what's called basis boost strategies, and sometimes this is perceived as a basis boost strategy. So if you're doing a more advanced technique like this, obviously we want to disclose where there are some potential challenges, and if that gives you any heartburn, don't do it. There are always more conservative techniques you can do instead. But as you can see, the benefits are very powerful. In this particular example, the client accumulates much, much more wealth. We can show you that if you just sold it outright, you would have maybe had $3.2 million, but if you have this strategy, you can have much more tax savings, much more income, much more benefits to heir, and much more estate tax savings. And again, we handle these illustrations on a case-by-case basis. I just want you to be aware that these types of techniques exist for those of you that want more benefits than you might get with a charitable tool. Now, the sixth and last side of the cube used to be the side I focused on first, the estate tax side. When I started in the business, the exemption from estate tax was $600,000, and pretty much anybody needed estate tax planning. And then it went to $1 million, and then it went to $5 million, and then at year end, the exemption went to $11.2 million. And so if you're married, you've got almost a $23 million exemption from estate taxes, and if you leverage that, you can avoid estate taxes on a $100 million estate. So the estate tax side seems like it's much, much, much less important than it was historically. But in fact, estate tax planning is extremely important, because what happened is back when the exemption was $1 million, those of you with more than $1 million probably went to your attorney and set up some sort of trust to move all the assets out of your estate. And even if you just have a traditional A-B trust, the B trust, the decedent's trust, goes in place when the first spouse dies. So what typically happens is the husband dies and the wife's alive, and usually these trusts have mandatory funding of the B trust, where when you die and your wife is alive, your half of the assets will go into the B trust, and then it becomes irrevocable, and there's what they call a carryover basis, meaning that as the value of the assets goes up, that increase in value will all be subject to taxes, capital gains taxes. And so what happened is we set up a lot of these B trusts. We also set up a lot of traditional dynasty trusts and had the clients aggressively take advantage of their exemptions and either gift the assets out to the trust or sell the assets out to the trust or have the assets go to the trust when the first spouse dies. And it made a lot of sense back when the estate tax was 55 or 60%. But now that the estate tax is 40%, you've moved all these assets out, you've got the same basis as the time you moved it out, so all the future growth will be taxed at a 35% rate, and that growth and that 35% tax could eventually be much more than the 40% estate tax you're trying to avoid. So for that reason, a lot of people with these traditional non-grantor trusts are asking whether they did the right thing. So very, very often now what we're doing is we're terminating the B trusts, we're moving the assets back into the estate so that when the husband or wife pass away, there will be a step-up in basis. And step-up in basis planning remains one of the coolest planning techniques out there, because all of your accumulated capital gains tax go away. All you have to do is die. I mean, it's not quite that simple, but it's a big tax benefit where all of your capital gains taxes will go away as long as somebody dies. Now, usually what will happen is your spouse will die or you will die, but it doesn't have to be you. There's a new type of planning called Upstream Planning, where if you've got a parent in his or her 80s or 90s, statistically they're going to die in the next 10 years or so, and maybe sooner. And you can actually move your assets to a trust where the parent has enough control over it that it's deemed to be in their estate for step-up and basis planning. Now, it doesn't need to add to their estate tax. There are ways you can design these trusts so that the assets will get a step-up and basis when your parent dies, but it won't be subject to estate taxes when your parent dies. That's called upstream planning. Obviously, traditionally, estate planning was all about downstream. It was all about not the kids caring for the parents, but the parents caring for the kids and the grandkids. It was all about the legacy you pass on across the generations. And indeed, biblically, Psalm 17 and other passages will talk about passing on the legacy across the generations. But practically speaking, you may want to temporarily put those assets back into your parents' name to get the step-up and basis, and then have it go to you or the kids. It's called upstream planning. Google it or send me a note, and I'll show you how to take advantage of that. Here's a benefit of unwinding a complicated plan. What we did very often is set up limited liability companies. We put your marketable securities and your real estate into a limited liability company, and then we gifted or sold it out to an intentionally defective irrevocable trust, an IDIT. And that way you avoided the 40% or higher estate tax. And it made great sense. You then had a zero taxable estate because you moved everything out of your estate. You then had zero estate tax. You had carryover basis. The $10 million of assets might have $2 million basis. So yeah, there could be a capital gains after death, but since you avoided the big estate tax and because the capital gains rate used to be really low, nobody really worried about that. But in the new world, with the capital gains rate so high and the estate tax so low, people are just collapsing the LLCs, they're collapsing these trusts. So then you have the $10 million with no LLC. You have no estate tax because with a high exemption, many people don't have estate tax anymore. You bring it back into the estate, so you get a step-up in basis at death, so then you have no capital gains tax. And because you avoided all the capital gains tax, and because the new exemption avoids the estate tax, you end out $2.4 million ahead. And this is the type of chart that can be customized for many of you, but you're going to see why many, many people are just collapsing those old irrevocable trusts and moving the assets back into the estate. So those are the 6 sides of the cube. And basically, the simple way to summarize all this is by asking yourself one key question. Even though we do a lot of advanced planning, I tell people the most important question with all estate planning, financial planning, and tax planning is how much is enough? I mean, it seems so simple, but really to do any wise selection, customization, and integration of trust, you have to know how much of your wealth is enough for you to live on. Do you need $20,000 a month? Do you need it for life expectancy? What's that number? How much is enough? And then once you take care of yourself, how much is enough for each of your kids and grandkids? When I started doing this 40 years ago, I'd say, how much is enough for your kids and grandkids? And they'd go, charity begins at home. Everything goes to my kids. Everything goes to my grandkids. And I can tell you now, with 4 decades behind me, the results are in. Usually when the kids get a big inheritance, it's a lottery winning. The studies show, and I've written articles on this, 95% of the time, the kids are going to lose the value of the estate you give them. If they don't lose the value, they lose the values. They don't understand what it took to accumulate. They don't understand how you or your dad or your mom poured blood, sweat, and tears into building that wealth. It just becomes a check in the mail. Now, there are lots of ways to deal with that through proper legacy planning, where you can get the kids mature enough. You can teach them budgeting. You can teach them stewardship. You can teach them how to manage the money. And so you can beat the odds, but the odds are against you. 95% of the time, they're going to lose the value and the values unless you're very deliberate. So more and more of our clients are saying, no, I don't want to make my kids rich. I'm going to give them each $500,000. Give them enough for a good education, a first home, a wedding. That's $500,000, even in California. Or give them $1 million. That's very common. Give them each $1 million. But rarely are people giving them more than $1 million. So you're asking, how much is enough for each kid? $1 million. How much is enough for you? $250,000 a year. What happens to all the rest? Well, you only have 2 choices, taxes or charity. And I'm hoping, based on this discussion today, you're persuaded that you're better off stewarding all wealth for God's glory through tax-efficient trusts for your retirement during your second half of significance, for your kids that are raised to fear the Lord, and for your favorite charities that further ministry. You can really use all that wealth for God's glory. One last very practical slide, and then I'll close, is when you look at your personal situation, there are probably 12 different types of income you could have. Most of you are getting a lot of wages, interest income, dividend income, rent income, taxed at the highest marginal rates. That's pictured right here. Most of you are probably getting very little tax-efficient income from bonds or Roth IRAs or those insurance policies or from tax deductions. If you simply change the character of your income across time, you have less and less tax across time, more and more tax-free income. It's not difficult over the course of 20, 30 years to have over $1 million of tax savings. This is just a really practical application. And this doesn't need to just be for your lifetime, it can be for your kid's lifetime as well. So the tax benefits are immediate and profound. I have to give my standard disclaimer. I'm a partner of a law firm that does zero tax planning. Everything we do can change. I mean, as Otto von Bismarck said, no man's life or property is safe while Congress is in session. And these laws can change. But I can tell you, in my 40 years, they've always been grandfathered. So if you get it done before it changes, you can be safe. I'll also say that we're available for personal consultations. I'm happy to send these slides to you, but most importantly, I'm just always happy to encourage you to remember that God's given us all this wealth to steward for His glory, and we welcome the opportunity to help you in that regard.